All right, let's dive into one of the fastest growing, most talked about, and honestly, one of the most mysterious corners of the financial world: private credit. To really get a sense of the scale here, I want you to start with just one number: $1.7 trillion. That's not a typo. That's the size of the private credit market today. It's now right up there with the entire high yield bond and leveraged loan markets combined. We're talking about a massive financial force that, for many people, has seemingly popped up out of nowhere. So, what exactly is it? Well, at its core, private credit is really just lending that happens outside the regular banking system. Think of these specialized investment funds loaning money directly to medium-sized businesses. These are the kinds of companies that are the absolute backbone of the economy, but they're often in a tricky spot. Maybe too big for a small business loan, but not quite big enough to tap the public markets. But that begs the question, right? How did this market get so huge, so incredibly fast? Well, its story is really a mix of opportunity, new rules, and Wall Street's unending search for higher returns. The story really kicks off after the 2008 financial crisis. You see, new regulations came in that forced big banks to step back from some of the riskier types of lending. This created a massive gap in the market. And you know what they say about nature pouring a vacuum? Private funds jumped in to fill that void. And the growth has been nothing short of explosive. We're talking from around $700 billion in 2018 to that $1.7 trillion figure in 2023, and it's not slowing down. Projections have it hitting $3 trillion. This isn't just a trend. It's fundamentally reshaping how companies get financed. And when you see growth like that, it's bound to attract attention. But it's attracted a new and, frankly, a very surprising group of players. We're talking about the apex predators of the financial jungle. Yep, that's right. Some of the biggest names in the hedge fund world, firms like Point72, Millennium, Citadel, they are all piling into private credit. Now, think about that. These are funds that are built for speed, for liquidity, for trading in public markets second by second. So the really fascinating question is, why are they suddenly so interested in a market that's famous for being the exact opposite? It's kind of like asking why a team of Formula One drivers, who are masters of speed on a perfect, pristine track, would suddenly decide to enter a gritty, long, messy off-road rally. The assets in private credit are illiquid, they're locked up for years. It just seems to go against their entire DNA. So what on earth is going on? The answer, as it so often is on Wall Street, really comes down to the math. And let me tell you, it is some very compelling math, all built on the incredible power of leverage. Okay, let's break this down. It's actually pretty straightforward. Imagine a fund builds a portfolio of these private loans, and that portfolio yields a pretty solid 12.5%. That's step one. Now, here's where the magic happens: leverage. Let's say they put up $250 million of their own money, and then they go out and borrow another $750 million against it. That's 3 times leverage. After they pay the 8% interest on the money they borrowed, they're left with a net profit of $65 million. And here's the kicker. Since they only put in $250 million of their own cash to begin with, that profit represents a staggering 26% gross return on their money. And that right there is the whole ballgame. That's why these funds are jumping in with both feet. With returns like that on the table, private credit stops being some niche little side project. It becomes a potential core profit engine that is just way too big and way too lucrative for them to ignore. But you know how this goes. A high-stakes game like this doesn't come without some pretty significant risks. The very private nature of this market creates challenges that you just don't see in the public world. And it all starts with a really basic question: what is any of this stuff actually worth? See, in public markets, everything is marked to market. A stock's price is whatever the market says it is right now for everyone to see. Simple. But in private credit, it's marked to model. That means the valuations are based on the fund's own internal spreadsheets and assumptions. This creates a ton of opacity and, you guessed it, the potential for people to have very, very different opinions on what the exact same asset is worth. How different? Well, get this. In one real-world case, a loan to the exact same e-commerce company was valued at just 65 cents on the dollar by one fund, while another fund holding the very same debt valued it at 84 cents. That is a massive gap. And when valuations can swing that wildly, it raises some pretty serious questions about transparency for investors, doesn't it? Okay, another tool that adds a layer of complexity here is something called PIK interest. PIK stands for payment in kind. All it means is that instead of the borrower paying their interest every month in cold hard cash, they just pay it by taking on more debt. So the total loan amount actually gets bigger and bigger over time. Now, this can be a useful tool, but it can also be a major red flag.
You really have to think of it as two different kinds of PIK. There's good PIK, which is offered right at the beginning to a healthy, fast-growing company. This lets them plow all their cash back into growing the business instead of sending it to the lender. But then there's risky PIK. This is when a lender offers it later on to a company that's clearly struggling to make its cash payments. It's a way to kick the can down the road and avoid a default, but it's often a screaming sign of distress bubbling just under the surface. And that brings us to what happens when a loan actually does go bad. This uncovers another huge risk. When a private credit loan defaults, investors get back, on average, just 33 cents on the dollar. Now compare that to syndicated loans or even high-yield bonds. It's significantly lower. You're getting less of your money back when things go wrong.
So why is that? Why so low? Well, it really comes down to collateral. Over half of all private credit loans are made to companies in sectors like software, healthcare, and financial services. And what do those businesses have in common? They don't have a lot of hard assets, factories, heavy machinery, big warehouses that you can seize and sell off in a bankruptcy. So when the loan goes belly up, there's just less stuff for lenders to recover. So you put it all together, explosive growth, these new aggressive players, and all these hidden risks, and it's no surprise that the entire private credit industry has been put under a microscope. And we're seeing both the market and the regulators starting to respond in a big way.
The future here is really being shaped by two powerful forces, coming from two different directions. We're getting new tools and we're getting new rules. On one side, you have market innovation, trying to bring transparency. And on the other, you have regulatory action, trying to bring protection. Let's break that down. You have big financial data companies like MSCI building these sophisticated new models to help investors finally peer through the fog and actually analyze the risk in these portfolios. At the exact same time, you've got the SEC rolling out major new rules that are going to force these funds to provide quarterly statements, conduct annual audits, and clamp down on the kinds of special side deals they can cut with their biggest investors. It is a full-court press for transparency. Which, of course, leaves us with the big multi-trillion-dollar question. As private credit finally steps out of the shadows and into the mainstream spotlight, will all this new scrutiny and all these new rules make the market safer and more stable for everyone? Or are the risks already baked so deeply into the system that it could become the source of the next financial crisis? Honestly, only time is going to tell.
This is not financial advice.